Welcome, good afternoon, or good morning for those of us who join from a different time zone. Welcome to our webinar on analyzing capital requirements for private debt in emerging markets under Solvency II. My name is Laure Wessemius-Chibrac. I'm the director of the NAB, the Netherlands Advisory Board on Impact Investing. We're an independent foundation in the Netherlands and part of the broader GSG Global Steering Group on Impact Investing network that has a presence in approximately 50 countries across the world. Last year, we actually did a research that I can show you. We published a state of the market research in which we analyzed what were the barriers that were preventing investors from scaling up their allocations in impact investment. And we actually found three main barriers. The first one was the market efficiency hurdle. The second one was the conservative investment culture. And the third one was the regulatory environment. And in particular, high capital charges for illiquid or emerging markets investments were mentioned by many of the interviewees. So since the role of the NAB is to address these barriers and try to co-create the solutions, we formed a working group with a number of our stakeholders to actually try to address this barrier. So I'm very happy to welcome you today. We will present the findings. The researcher that wrote the report together with the steering group, Julian Sebastian Nistroy, will be giving a quick presentation of the findings of our report. And then we will have, with our esteemed panel, conversation around the findings. And a little bit later, we will open the floor for questions from the audience. So if you would like to ask a question, you can already put it in the chat. And on the technique side, we will select some questions to which the panel will answer later. And finally, the chair of the NAB, Yvonne, will be closing this panel. So without further ado, I would like to give the floor to Julian, who will give the key conclusions of the report. Welcome.
Hello, everyone. Thank you very much for the introduction, Laure. I'm happy to be here, and I will be talking about the methodology and the main findings of our report. So to investigate capital requirements in impact investing, we decided to focus on private debt in emerging markets under the Solvency II directive. For the asset class, private debt in emerging markets has been considered as most relevant since private debt is the most widely used asset class in impact investing, globally and in the Netherlands. Thereby, especially emerging markets are most significant for impact investing. The Solvency II directive that dictates the capital requirements of insurance undertakings in the EU has been chosen exactly because it applies on the EU level. The research idea to investigate the appropriateness of the capital requirements that are imposed by the Solvency II directive is quite simple. We have access to a 20-year track record of private debt in emerging markets by European DFI. The data mainly consists of default and recovery rates. Using those loan data, we first calculate the Solvency II capital requirements for a hypothetical portfolio that consists of the loans in the data. Secondly, we employ a risk metric that is designed to capture the same risk level as targeted by the Solvency II directive for the same loan portfolio. And lastly, we compare the outcomes of the Solvency II capital requirement calculations and the risk measure to determine the appropriateness of the capital requirements. The Solvency II capital requirements, in short a.s.r, are meant to ensure that insurance companies can meet all of their liabilities, even under adverse conditions. The SCR specifically is designed to reduce the risk of insolvency to a 1 in 200-year occurrence in the subsequent year. This necessitates a capital buffer that is as high as the statistically expected loss over a year with a 99.5% confidence level. Within the directive, the SCR can be computed using either the standard formula or an improved internal model. This presentation focuses on the standard formula, since it is almost always used to determine the SCR of our asset class of interest. The formula adopts a modular approach. Individual SCRs for different instruments using distinct risk modules are calculated. Then they are aggregated to arrive at a total SCR for an insurer's balance sheet. For this research, we are interested in the individual modules that prescribe the SCR for private debt in emerging markets. In practice, there are 5 ways in which the SCR for private debt in emerging markets can be determined. This includes the internal model that can leverage on external data, such as the current report, to be constructed. Within the standard formula, the SCR for a loan comes from one of the 3 submodules listed, never from multiple. In most cases, the capital requirement for the asset class is determined by the spread risk module. It comes from the counterparty default module instead, if there are certain securities underlying the instrument, like government guarantees or collaterals in the form of buildings. Lastly, in practice, loans may be misclassified under the equity risk submodule, if there's, for example, very low exposure to the asset class in an insurer's portfolio. We will focus on the spread risk and counterparty default risk module, since either of those modules officially determines the SCR of private debt in emerging markets. The spread risk SCR for bonds and loans is a function of the duration, measured as modified duration, and is defined for each credit quality step as depicted on the screen. In this case, our assets are mainly not rated. In the graph, they are represented by the red line. The average modified duration in the dataset is around 4 years. This means that the SCR for the loans in the data is at 12% for those that fall under the spread risk module. The counterparty default module differentiates between type 1 and type 2 exposures. Type 1 exposures are usually not diversified and the counterparty is rated, while type 2 exposures are usually diversified and not rated. Most private debt in emerging markets falls under type 2 exposures. For type 2 exposures, the formulas to calculate the SCR that are given in the directive are displayed on the screen. First, the loss given default is calculated using the first formula. Given the loss given default, the SCR is calculated using the second formula. In our data, we arrive at an SCR of 11.23% for the loans that fall under the counterparty default module. Now that we have found the relevant SCRs for the loans in our data, we will apply our own risk measure, a value at risk 99.5%. The risk measure captures the same notion of Solvency II directive aims to capture. This is achieved by creating a yearly expected loss distribution for a hypothetical portfolio that consists of the loans in our data using the default and recovery rates. Next, we inspect the 99.5th quantile to glean the statistically highest expected loss in 199 out of 200 years. This may be easier to understand when inspecting the final graph. It shows the expected loss distribution of a given year in our data. Most of the time, the expected loss is at 0%. With a chance of 50%, it is below 2.81%, the median. The 99.5th quantile is at exactly 12%. This means that in 99.5% of cases, the statistically expected loss is at most 12%. Since this is a yearly distribution, this shows the amount of capital that shall be held by an insurance undertaking in order to cover all the losses arising from this portfolio in 199 out of 200 years. This is what Solvency II aims to achieve, and thus this value can be compared to the previously calculated SCRs. Here we see all the results summarized, including the equity risk module. It can be seen that the results from our value at risk 99.5% measure are the same as the a.s.r. prescribed by the spread risk module. The expected loss of 12% is slightly higher than the a.s.r. prescribed by the counterparty default module. However, as only contracts with a certain guarantee fall under the counterparty default module, the calculated 12% is most likely a slight overestimation of the loss of such instruments, as the expected loss of the subgroup of contracts with such a guarantee is expected to be lower than that of all loans in the data, which means that the a.s.r. of the counterparty default risk module also captures the risk of the asset class fairly well. Lastly, it can be observed that the equity risk module overstates the risk of the asset class, underlining the fact that the a.s.r. for private debt in emerging markets should not come from this submodule. In summary, our calculations indicate that the anticipated loss in the hypothetical portfolio remains at or below 12% in 199 out of 200 years. This closely aligns with the capital requirement mandated by the Solvency II directive. Thus, the capital requirements stipulated by the Solvency II directive accurately capture the risk associated with private debt in emerging markets in our data, meaning that the regulatory risk assessment within the framework of the Solvency II directive does not present an unjustifiable obstacle to impact investing.
Thank you very much, Julian, for this presentation. So this was a little bit technical, but we wanted to present the very thorough research that we have done, and with the help of many experts, including some of them actually present here. So it is my great pleasure to introduce the speakers of our panel today. Yvonne Bakkum, who is until the end of this month, representing FMO, but you're also the chair of the NAB, and you were a chair of the specific working group. Welcome, Yvonne.
Thank you, Laure.
Philippe Smit, you are senior investment strategist at a.s.r, and you have been guiding us through the technicalities of Solvency II during this 1.5 years of research. Welcome.
Thank you.
Jos Kalb, you are a portfolio manager at Cardano, and you have been one of our peer reviewers for this study. Welcome as well.
Thank you.
So we have concluded, Julian and the working group has concluded that Solvency II has a level of capital charges that is adapted to the risk that we have tested, and we also have seen that these capital charges are not that high. So why did investors actually tell us that these capital charges were too high for them to invest? Yvonne, what do you think? And what could you summarize for us the discussion that we've had in the working group?
Yes, well, as you can imagine, if you're looking at this webinar, that we were very surprised by this outcome, because it was our hypothesis that capital requirements would be too high, because that is an argument that is often used by investors for being very hesitant to allocate in emerging markets private debt. And when you talk about impact investing, it is clear that this is truly in its essence a matter of asset allocation, because you want to allocate to where you can realize the best impact with your capital. Well, if solvency requirements deter a certain asset class from being allocated to, that is of course a serious obstacle. So we felt that we really needed to dive deep into this presumed obstacle. And yes, we were surprised, but of course also quite happy to find out that the obstacle is more an assumed obstacle than a real obstacle.
So we actually have discussed a little bit these assumptions and these perception, and the title of the report is Changing Perceptions. That's something that we hope to do. Can you guide us a little bit through the cycle, I would say the vicious cycle of negative perception that maybe is leading investors to think that capital requirements, capital charges were too high?
Yes, and thank you, Julian, for coming up with this nice graphic summary of this cycle. Because, of course, as a researcher, when you find out that these capital requirements are not in reality the real obstacle, you have to ask yourself, what then are the real obstacles? And I think it's very justified to say that because this asset class is so small, in most portfolios, especially of institutional investors, it doesn't get a lot of attention. So within the risk departments of the institutions, fewer resources are invested to understand the intricacies of these assets. And then if it's such a small part of the portfolio, it's tempting to, for instance, group it with other private assets like private equity. And then you can easily imagine that the outcome in terms of the capital requirement is much higher than this private debt asset class really deserves. Because private debt in emerging markets is in reality quite a stable asset class, which doesn't have the risk profile of private equity.
Yeah, that's right. And can I ask you, Jos, when you read the results of the report, so what was your reaction to it when you found out?
My first reaction was, this is spot on, the result with the standard model. So then you dive deeper into the data, you see that the research is solid, that has been performed, and then it's an interesting outcome that indeed, like the standard model assumes, it's like BBB, BB rating area to which you can classify these loans. I think it's a very interesting point that that investors can have extra input on how to look at these private debt investments in emerging markets. And what is also interesting, I think, is that if you then compare the Solvency II regulation against the Dutch FTK regulation, and it looks like that the FTK charges higher capital requirements for emerging market private loans. So I think it is a good starting point for both pension investors and insurers to reconsider, okay, how can I allocate my illiquidity budget to private debt in emerging markets where I can make an impact as investor?
Yeah, so reconsider the possibilities and the opportunities. Philippe, was it a surprise for you to see the results?
I was part of all the analysis that was being done, and I was a bit apprehensive when we started because data is a big issue on this asset class, and I think that's also a reason why the risk is usually presumed very high. It's also in the graph that Julian made, and I was very surprised by the result in the data. So I was very happy that we were able to disclose this data, and it resulted in something that did surprise me in the end, that it was relatively well charged under Solvency II. So yes, it was a surprise.
Yeah. So it's good that we conducted this research. One of the things I personally discovered that surprised me a lot when we did this research is that illiquidity is actually not really an aggravating risk factor under Solvency II. So why do I always hear, every time I engage with institutional investors about private debt in emerging market, that illiquidity is such an issue? I mean, maybe staying with you, Philippe, do you have some ideas?
I think if you have an illiquidity mandate, you have to choose where you invest. And the less you know, the more uncertain you are about investing in this asset class. And I think you'll look for arguments to validate your decision. And since data is scarce, we did have a lot of trouble getting the data initially. It makes it hard. It makes it easy to argument that liquidity is an issue, and therefore that you should not invest in it, and that's an added-on risk where you want a certain return for.
Yeah. So it's just really all the negatives, or the unknown. Actually, it's not really a negative. It's just the fear of the unknown.
Yeah.
Yeah. And from your perspective, Jos, illiquidity, is that really an issue?
I think if you do your homework, it's not, but you have to do it, so it takes effort. I think one point I want to make is that it's also that a lot of investors, they are comfortable to invest in emerging market bonds, but if you realize in times of stress, it's also not that liquid, and also the price you will get at those stress times is very low. So then you can, maybe you have liquidity, but at the times you maybe need it, it's not there. If you compare that to private debt investments in emerging markets, if you make sure you do your homework and you have a good governance and you have a close relationship with the borrower, and one of the advantages of being in private debt is that you are closer, you have more insight in the financial statements, in the processes within the company you're lending to. It really can make a difference that you get a better risk return than just investing in liquid bonds.
Yeah, and if I may add, this consideration, Jos, that you describe is of course the traditional consideration of risk and return, where illiquidity is then seen as a risk. But of course, as a NAB, we advocate a different approach to investing, where besides risk and return, we also factor in impact. And if you then think about the difference in impact you can realize with more long-term capital like private debt compared to, for instance, bonds where you can get out whenever you want. And also, if you think about the emerging markets universe of corporate bonds, there you don't reach the full spectrum of the local economies. And private debt in that sense has a very different profile, which is more aligned with an impact-minded consideration of making your investment decisions and, more fundamentally, your asset allocation decisions.
Yeah. And is that also the case? Something that is also linked to the asset class is volatility or less volatility in the case of private debt. What would you say? Why is less volatility actually? Was it interesting for institutional investor actually to move towards more private debt?
If I may, I think to some extent, yes, or to a large extent, because it will ensure some anti-cyclicity. So because the valuation is more stable, it will, or maybe slightly lagging, it will help you in times of stress where this value might be higher. On the other hand, you have mark-to-model valuations for some corporations, and that might be might cause some additional volatility. But I think in general, if the data is available and you have a good set of market values that you for these assets, then it will dampen your, it will stabilize your balance sheet and dampen it for volatility in the markets because of anti-cyclicity.
Yeah, so that's also like a diversity
helpful.
in your portfolio. That's really that's another
it's
risk
a bit the same
element.
as real estate or something like that.
Okay, maybe moving on to you, Jos. How do pension funds look at private debt in emerging markets, and how does this change maybe with the new pension agreement that we're looking to have in the Netherlands?
That's a good question. Yeah, I mean, private debt is not an unknown asset class for pension funds. Many pension funds are already active in this space. But with the upcoming changes in the pension world in the Netherlands, especially, if you look at the different contracts we are transitioning towards, you can look at the solidarity contract, in which is simply said a continuation of the existing defined benefit systems, and there you have a large flexibility to allocate assets towards illiquid assets like private debt in emerging markets. I think there is really an opportunity there for the pension boards to say, okay, what are our priorities? We really want to make an impact. Then the highest impact I can make is in emerging markets in private debt, because you have a very close relationship with the borrower, and you can really have clear KPIs on the impact you are making. I think it's also important, if you look at the flexible contracts that also pension funds are transitioning towards, it's also still very well possible to allocate money towards illiquid assets. There you have to be more flexible, because you have to pool your private debt with liquid debt to be able to have sufficient buffer in case of adverse market movements, that you can still provide the liquidity within the debt or the bonds pool. And for example, if you group private equity with equities within the equity pool, but there are still a lot of possibilities there to make your asset allocation decisions. So I think it's for pension funds really again time to really start thinking about what are my main goals, and how can I achieve the highest impact in this world. So I think it's really time to reconsider everything.
Yeah, thank you.
Yeah, and this research, of course, focused on Solvency II, which is relevant to insurance companies, but it's actually quite timely that we can contribute these findings to the market also at a point in time where pension funds are in a position that they can actually reconsider their way of investing.
Yeah. And I would add to that it's all about risk management. I think risk management is universal. Of course, we looked under Solvency II because we were looking for a European level regulation to be able to apply this outside of the Netherlands as well. But obviously, risk management does not differ much, even if you're a bank or a pension fund or any other type of asset manager. I hope that this data can be used by all our audience, and obviously all type of institutional investors.
Exactly, because the loss distribution is the same. So once you have that, you can decide what your loss appetite is, and you can determine how much risk results from this asset class.
Yeah, and I'm really happy that this provides also some objective confirmation of something that, we as development finance institutions have known for years by looking at our own portfolios, that it's actually good business to invest in private debt in emerging markets.
Yeah, it is. So I would like to expand a little bit by thinking about the term of investment also of investors. Mark Carney talked in his speech in 2015, I think, about the tragedy of the horizon, and the fact that actually referring to short-termism of supervising entities, that was really an existing difficulty to really assess the extent of the risk presented by climate in particular. our report also refers to the short-termism of investors. So can all of you actually tell us, why do you think that investors are so short-term focused? Maybe who wants to give it a try?
I can kick off. Yeah, I mean,
Yeah.
it's. I think the incentives are also very short. If you look at for example, in the financial sector, you clearly see that there is still a short-term incentive for financial companies that have bonuses. So the bonuses are often every year. So people are always trying to come with short-term results. Well, if you look at problems like climate change, these are very long-term challenges we have, and it's therefore difficult. It's also behavioral aspect that people tend to have difficulty to plan things for the very long term compared to having short-term gains. So I think it's very much incentivized still towards short-term goals, and also while climate change, for example, it's a really long-term challenge in which you have to continuously make efforts, and it's not something you can do in 1 year. So I think it's something a lot of investors struggle with.
Yeah.
I agree with what you're saying, and I think there's an added component there that a lot of the analysis done for the long term, because how do we understand long term and bring it to our short term vision, is by using models. And if you look at these models, they usually look at an exchange between investing in something that will supply a return or investing in something that will reduce the damages in the future, which is what impact investing for, especially for climate change, does. And if you see the decrease in return is relatively equal to, in many of the models, in macroeconomic models, relative to the damages being done, then there's no real incentive to do something about the damages, because investing or reducing the damages is the same as I get in investing something else right now.
Doing nothing, basically.
Basically doing nothing. Yeah. And I think, so these macroeconomic models, they should help us decide that we should act, but instead they give us a different incentive. And it's through the assumptions that we put into these models that we lose sight of the real impact, because there are a lot of different studies that show that there should be a lot of impact, but we're not seeing it in many of the climate scenarios like the NGFS and so on. The impact is very limited, and I think that's a result of the assumptions being made.
Yeah, this is really interesting, huh? And of course the tremendous attention that especially climate change is getting, and the efforts that people put in to understand this in a very technical way with the science-based standards, and it is on the one hand very good and positive that there's such an attention for such a pressing problem, but on the other hand, we should never rely on models only, and we should keep using our,
common sense.
Yeah. Exactly. And there's this common sense aspect in impact investing that I think the more strategic your role is as an investor, the more you should really keep in mind what you are achieving and what you want to achieve, and whether your practice is in line with your with what you claim you want to do.
Yeah, that's also the alignment of your mission and the translation into a business, an actual business plan at financial institution level is also quite a challenge. And I think, maybe to summarize, so we should maybe also call international instances and maybe regulators have a role to play there to have a better calculation of the cost of doing nothing, basically, because that would, I mean, you often read in the press that the cost of doing nothing is much higher than any investment we can make right now. But actually, if I hear you, Philippe, that's not really the case yet. At least for the financial sector, this is not something tangible that we can put in the financial sector models. So, well, hopefully we'll make some data available now. That's a start, but I think it's maybe a call to further do our homework as a sector to try to get more substantial data available for the models. I'm going to maybe open the floor for questions from the public. And we already have a first question from Jasper Kool. Climate change is already here. What will all the flooding, fires, and hurricanes cost in terms of finance impact in 2023? So that's maybe a question for the insurance. The insurer, have you actually worked? I mean, maybe this is quite specific, but are you already working on that acceleration of extreme climate events at a.s.r?
Yes, we are. It's something that has a lot of focus for us long term. We also publish it in our annual reports, what we think the impact is. And this is for 2023. I haven't looked at the current data, so I'm not really sure what the reinsurance companies and so on say, because they are the experts, and especially since 2023 is almost over, those calculations should result in a clear number. And again, I'd like to link this to the short-termism as well, because climate change is something of the long run. And we're looking at how welfare standards will evolve if there is no climate change or if there is a lot of climate change. And so I think it's very important to look at this on the long run. And then the damage may be very material, which we see. And again, in some models, you will see a lot of damage. There's a very good article in the National Geographic about all the climate damages and all the analysis done. And then you see that there's a huge range of how much damage is predicted in the future. And yeah, depending on which one you choose, you get a different result. So it's very much assumptions right now, and uncertainty.
What will be the cost tomorrow if we don't act today? I see there as a next question, and I think we cannot answer it. But it's
very difficult.
What is pretty obvious is that the cost will be huge, and that the thing about recent climate conditions, well, at least it makes absolutely clear that we have to act now. And this isn't anymore a problem for the future. This is already a problem for today.
Yes. So I would like maybe to come back to you, Yvonne, because we realized that actually the barrier is not really the regulation. The barrier is more the perception of risk from institutional investors. And so as a NAB, how can we basically further help the market to develop or change behaviors? What could be solutions? What would we recommend to
Yes,
improve
I think
the situation?
One very clear conclusion from this research is that it has been extremely useful to investigate this data set. But we also acknowledge that this data set was the data of only one institution, and that investors and regulators require lots of data to make sure models are sufficiently robust.
Yes.
So as a NAB, I think we can play a role, and we are already working on it, to lobby for better availability of data. And for instance, the emerging markets private debt database that is being kept by the GEMS, the Global Emerging Market. I don't even know what it stands for, but the GEMS database has the default and recovery rates of virtually all the development finance institutions and multilateral development banks in the world. So that's a much wider data set. And if we can push for that data to become available to the public, to investors as a public good, rather than being kept only for internal use to calibrate the institution's own risk models, I think that would be an important step.
Yeah, I agree. And just for the record, the report was based on one institution, but that had a very long and extensive track record. So we had more than 1,300 entries to calculate to compare the track record and calculate the risk levels. So
yeah, but when it comes to data and models, I think
the more
the better, right, Philippe?
Yeah, I always want more data.
So this is one element. I would maybe add another one. I think a perception of risk is, of course, a very it's a sort of underlying emotion, and we really need to fight this. And I think as a NAB, I would like, and also I would like to invite the audience and all the persons that will read the report to share the results of the report and educate, obviously, all the institutional investors that they are in contact with. So for me, it's a call to action as well. Please use this primary data and share it and spread it and fight actually the myth surrounding the high level of risk of private debt in emerging markets. I think so. We have another question. The point about how investing in corporate bonds doesn't give the same breadth of exposure to the local emerging market economy. Could you give an example of a good private debt impact investment to further illustrate the opportunities? What's different between corporate bonds and private debt?
Yeah, thank you for that question. Well, for instance, and someone once used a nice abbreviation, and that's why I easily remember it. When you look at listed equity and corporate bonds, for instance, in Africa, which of course is a continent where the Sustainable Development Goals still have a very significant gap for being realized in 2030. Well, through the listed markets, you reach the BBC, and that stands for banks, beer, and cement, which obviously is a very limited representation of the diversity of these economies, because we have in Africa very interesting companies active in, for instance, agribusiness, providing much needed food for the local population, but also the amount of fertile land available on the continent makes it also very interesting for exporting foods to other parts of the world. So that is an example, but also in terms of climate investments, renewable energy projects, they are typically greenfield projects that you do not typically finance through listed instruments. And you can finance it through project finance, which is a form of private debt. So those are just two examples to illustrate how you can do more with private debt.
Yeah, certainly. And I think since the COVID, we've seen that the financing gap in emerging markets to achieve the SDGs have jumped from $2.5 to $4.5 trillion, which is massive amounts, of course.
That's per annum.
Yeah, that's indeed that's per annum. To give a sort of proportion, an idea of the proportions, the total assets under management globally are probably a little bit above 110, 120 trillion dollars. So we're talking about 3 to 4% of the total assets under management, which would be needed. That's quite a lot. So we have a question from Hadewig Kuiper. What would the institutional investors in the panel like to see as the next research topic for the NAB to dive into? And what barriers to impact investing to address? So maybe we can start with you, Philippe.
That's a very good question, and one I was somewhat unprepared for. But I think we address the risk right now, and I think there's another component, that's the return. And I think if you want to fully round off your analysis on the, especially on the presumptions on impact investing, I think you need to look at both. So I think that's the first one.
And I assume then you mean the financial return or also the impact return?
I think both, because impact return is very difficult to quantify, and I think all institutional investors are looking for ways to quantify this, so they can report on it, so they can supply it to either their members or their stakeholders. And so I think you need to do both. I think you have the financial, which is, we're a financial institution, we have to look at the financial side. But we also have to have a sort of uniform way of communicating how much impact we make, and maybe some standards that we can use to help report on our impact. And I think there are lots of funds. We had this discussion before we had a call, and some investors have a very different view on what is impact. And sometimes impact is already what's already in the legislation. So they're not doing something extra. And the question is that still impact? And I think helping to identify these topics and helping to navigate these topics is, I think, a very valuable research item.
So harmonizing definitions of impact, what is impact, what isn't?
Maybe not fully harmonizing. I don't think a standard should be supplied, but maybe seeing the different interpretations, so that at least people know, and looking at ways how you can report it.
Yeah. So sharing best practices and promoting some form of harmonization, I think, of how people report impact. That's
I think the market will do some of the harmonization because they will pick and choose in the end, but knowing what's out there is a big step of harmonization. Yes.
Yeah, that's a good one. From Cardano's perspective, what barriers are you still?
Maybe I think maybe it's a nice opportunity to also do more interviews with the different investors in the Netherlands. You can talk to many pension funds and insurers. Okay, how do they consider impact, and what are their hurdles? To maybe more less quantitative analysis, maybe but more qualitative analysis about what is driving the investors, what are their considerations, concerns, what are the struggles. I mean, I can imagine it's also not easy nowadays to be in a pension board or in an insurance board. So to have more interviews with a different type of players in the market to see, okay, what are their considerations for impact investing, and how do they view it? So it's maybe less quantitative this time. Sorry, Philippe, but maybe more qualitative interviews.
Yeah.
Good news is we're going to start working on
Exactly.
that, exactly. So, and we're working on harmonization with our colleagues from other European labs and other organizations. So hopefully we'll try to respond to that gap in the market in the future. I see another question from Arno Gil. What is your institutional view when it comes to blended finance models for private debt in emerging markets?
I think it's a very good idea. I mean, as we mentioned before, the funding gap is so huge. It's impossible for the DFIs or the governments to fix this gap on their own. And I think it's smart to use a blended finance approach by which you can maybe attract investors that normally are on the sidelines. They are scared to step in. They want to have more assurance. So by structuring transactions more on a blended finance way, in which the first risks are taken by a DFI or maybe by a government, then you can make the more senior part of the impact investment more accessible for institutional investors. So I think I personally like the idea of blended finance very much, and I think you can leverage the dollars or euros you put in it as a DFI or government by using this form of financing.
I think maybe can I ask a little bit of a controversial question? Because sometimes you hear that blended finance is a little bit abused by institutional investors to still earn money without taking any risk. Do you think that's the case?
No, I disagree. I think if you have different risk levels in an impact investment, you should have all the parties that have skin in the game, and it's not so that it's a riskless investment then for the institutional investor, but it should be a win-win situation in which the senior investor has a good risk return, but also the government or the DFI that takes the more junior part of the debt has a higher return, but also a higher risk.
Yeah,
so
okay.
I think I'm a fan of this concept.
All right. Maybe moving on to one more question, Florian Gros. Could the institutional investors give us a range for an acceptable risk or loss given default and an acceptable return for private debt in emerging markets? So, Florian, I know you. This is very specific. Any ideas?
Risk and loss given default are very. They depend a lot on your capital structure and on your return requirements. So this is a very difficult question to answer.
Yeah.
It depends a lot on your institution, how easily you acquire capital, how much is your, how are you capitalized, how diversified is your portfolio. So no, I can't. I'm sorry, but I couldn't supply you with a single range for this answer. But I think what I do agree with is what Julian showed in the analysis with a 12%. That's a standalone loss, and what you'll see there is that it is relatively comparable to what Solvency II thought applicable to assets of this risk profile. So in that respect, I think there you have something of a range, and it seems based on the risk return we saw in that portfolio that it's adequate. So turning the question around, no, I can't give you a range, but I can show you that analysis does show that there are assets within this asset class that have an adequate risk profile. So I think you should approach the question also differently.
Yeah. Thank you. Maybe a last question before we wrap up. Bruno Bezek from NN. So Bruno agrees with you. Philippe, what are the sources for highest real world impact? For example, is divesting from a fossil fuel company, engaging with it, or investing in renewables? What's making the highest impact in your view? And I think it's, by the way, a question shared by many impact investors as well.
And it's a very difficult question because we need fossil fuel to drive the change, and we can't stop now. If we do, then we won't be able to make the change because the world isn't working on renewables yet. On the other hand, if the fossil fuel company doesn't have a roadmap towards a renewable world and is not willing to discuss it, then how can you choose to invest in it? Because you know it's going to be a stranded asset in time. There are lots of risks, and then you're really doing it for the short-term gain. So it's more of an ethical question than just a straightforward question. I know as a.s.r. we did decide to step back from fossil fuels. I think we made a very well-considered choice in that, but because we think that engagement isn't resulting in enough change, but it's a question every corporate should ask itself and should try to get their corporate ethics aligned in answering this. And I think it's an important question to ask.
Yes, and as you said here, it's also a matter of what is your horizon.
Yeah, exactly.
Yeah, so maybe on these considerations, aligning your investments on your values and looking at the long term and the horizon, I would like to give Yvonne the last word for closing, because we're approaching the end.
Thank you, and thank you very much also all the participants for your very relevant questions. And well, thank you, Julian, for the good work you did in this research, and you also made it your thesis. So this was a fantastic win-win cooperation that we had. And thank you to the panelists representing the organizations most actively involved in this working group, Cardano and a.s.r. But more institutions were involved, and I will not name all of them here, but for sure they are acknowledged in the report, and that report is available to everybody as of now. I think someone will push a button.
Yes.
Simona in the back of this studio will push a button for all of you to be able to access that report that I'm really proud of, and I really compliment the NAB team on getting that done. And thank you for organizing this webinar.
Thank you very much.
And thank you for being with us. Bye-bye.
Goodbye.
Bye.